From New York City for our viewers worldwide, I'm Jonathan Ferro with 30 minutes dedicated to fixed income. This is Bloomberg Real Yield. Coming up, Congress clears legislation to suspend the US debt limit. President Trump would like to scrap it altogether. The global synchronized growth story does not resonate with the bond market. Treasury yields grind down to new lows for 2017. And 2018 looks increasingly uncertain. The ECB is still exploring QE options, and the White House is said to be considering 6 candidates for Fed chair. We begin with the big issue. President Draghi urges patience as the economy continues to outperform.
It's hard to talk down your currency when your fundamentals are improving.
The currency has been a headwind, but we believe it's well justified, this currency strength, by the domestic strength of the economy.
The reason why they're not too concerned yet about the euro is because it seems to be an endogenous appreciation. It's a result of the good demand shock. It's not an exogenous shock. It's a manifestation of confidence in the eurozone and in their policy.
The Eurozone's now growing as much as the United States. And so I don't know if you change monetary policy, I don't know if it affected much. I think the Euro's correcting for a change in growth rates that's now reestablished in the Eurozone.
He's obviously trying to tightrope between not announcing or pre-announcing some kind of a tapering decision, running ahead of the governing council. So he really didn't have a lot of leverage with his words.
Joining me around the table here in New York City is Robert Tipp. He's head of global bonds and chief investment strategist at PGIM Fixed Income. Also alongside us is Eric Stein, co-head of global income at Eaton Vance. And coming to us from Dallas is Trey Parker, partner and portfolio manager at Highland Capital Management. Gents, great to have you with us on the program. Here's the thing that jumps out at me over the last couple of months. It's the message that seems to be received by FX and bonds in Europe and the divergence between the two. And we can throw up a chart. Bunds versus euro dollar. And my first question goes to you, Rob. Why can we have a market that drives bond yields ever lower over the last couple of months and the euro ever stronger?
Right. Well, I think if you look back over the last 5 years, the money was first leaving the eurozone with the crisis. And then after that, they moved on to a new mode of stimulus. They broke any link to the idea that this was a Bundesbank base central bank motif, that they would never do QE, and they went massively into QE, and they were groundbreaking in terms of a major central bank going negative on interest rates. So they were chasing money out, and as if that wasn't enough, then we moved on to political fragmentation and populism, concerns about the Netherlands, Austria, the Greek package was in the balance, and still there are concerns in Italy, and you had the Le Pen situation. So now, if you fast forward, you're past the Dutch, the Austrian, the French outcome was phenomenal as far as Europe is concerned. Italy is kind of the only outlier there, and the money is now coming back. So Europe is a place where the underlying fundamentals of being a savings bloc, say like Japan, which had an ironically strong currency, is there. Now they have a cyclical upswing going on. The politics are coming together. And unless you have steady outflows on the portfolio side, this is going to be a strong currency.
Well, that all makes sense, Eric, except bond yields at negative 76 basis points on a 2-year when we're talking about growth and a structural reallocation to Europe. Why do you want 2-year notes out of Germany if you're going to have a structural reallocation to Europe?
I certainly wouldn't. Look, I certainly think there's still some fear premium in German bills. There's also the issues with the ECB buying bonds. There's not that many of them.
Well, that's my point here as well. If I truly believe that the ECB is going to step back, then okay, a stronger euro, but then why aren't 2-year note yields in Germany higher and materially higher?
Well, the question is, when are you going to get the deposit rate increase? And I think Mario Draghi really has to tightrope monetary policy because he does not want the euro that strong, but he wants to slowly normalize, slowly slow down the pace of quantitative easing. So I think that's a big reason. Also, just look at global yields. Global yields have been falling, so bond yields are going to fall as well. Also, when you look at the euro, the way we always look at currencies, at Eaton Vance is one versus the other.
Of course.
The dollar has been weak this year. So part of the euro's appreciation is just the inverse of dollar weakness, in addition to all the positives that we just mentioned on Europe.
Yeah, Rob?
The other thing on bonds, of course, that's unique is there's literally no supply, right? They have no budget deficit. It is a fixed supply. It is a small market to begin with. And then the ECB is buying based on their capital key, which means a quarter of their purchases every month are getting squeezed into the bond market. So that market's really the leader in terms of being under pressure of distortion as a result of the asset purchases.
Trey Parker, I want to bring you into the conversation. After hearing from President Mario Draghi of the ECB yesterday, what's the base case for you guys now on the recalibration of policy later this year if it does indeed get announced?
You know, I think Mario is still trying to walk a tightrope, as Eric, I believe, mentioned, in terms of, you know, waiting and seeing the data. I don't think he's too concerned right now about the euro strength, because on a trade-weighted basis, the euro is only up about 6% so far this year, and I think that they can handle that given the growth outlook that they're seeing across the eurozone. So we still think that both the Fed and the ECB are still in a wait-and-see mode as it relates to policy actions later this year, understanding that they both want to have more ammunition as we get later in the credit cycle.
Well, Trey, is this going to be a move from 60 to 40 for, say, 6 months? Is it a move from 60 to 20 for, say, 9 months? The base case in terms of what they will announce, where are we?
You know, I think they're going to start moderate. I think this is too big of an experiment to go aggressive with the reduction of the tapering. And so just like the Fed, I think that they're going to guide to some moderation initially, see how that goes and how well that's absorbed in the markets relative to the rates, and then potentially increase it later in 2018.
Rick Reeder of BlackRock has come on this program before, and he talks about obsessing over the shark nearest to the boat. And the shark nearest to the boat is what the ECB does next and what the data is doing, what happens in DC. About a mile away is an Italian election potentially. Does European politics, Eric, reassert itself at some point into the bond market, into financial conditions, into Europe?
I think it could. I mean, certainly there's been a lot of positives this year with the French election and a lot less kind of not geopolitical, but kind of tail geopolitical risk, I guess, in Europe. But Italy isn't really growing. A stronger euro doesn't help Italy. There's a lot of debt, yes, right now with low bond yields and contained spreads because of ECB purchases. Italy's debt trajectory is sustainable for right now, but if bond yields were to normalize, Italy's debt really isn't sustainable. So I think that is still an issue in Europe. And just like markets may have gotten over concerned with populism after the U.S. election and Brexit last year, markets might be getting overly optimistic given the French election. Europe, there are still issues at the core of how much sovereignty should countries have versus how much commonality should they have.
Rob?
Yeah. I mean, it's a little bit complicated, but at this point, if you compare the U.S. and Europe, when they created the euro out of nothing, they created this system, they really created a tremendous fiscal process that they immediately violated en masse. And what's happened with the crisis, post-financial crisis and then going into the euro crisis, is they have really regrouped. And so at first, they wanted to try the private sector involvement. And that obviously was a disaster. And instead, they tightened the fiscal restraints, they tightened the processes for approval of budgets, and then began to make examples out of individual countries when the Eurozone was acting in a position of strength. Example of that, key one was Cyprus, where basically they restructured the banking sector and took the money out of deposits to right the situation. So how does this matter for Italy? Italy now, if Europe was in disarray and they have Italy on the brink, they're a little bit owned by what's going on there. But right now, the rest of Europe is doing great, and Italy looks like the odd man out. So you're seeing the politicians there step back from their rhetoric of introducing a second currency and so on. And I think they're going to make their way through, although granted, it's not a great-looking situation.
Well, you think about how tight things are trading right now. Earlier this week, the CEO of Goldman Sachs, Lloyd Blankfein, came out in an interview and he made the point that he worries when corporate bond yields trade below dividend yields. And look no further than Europe. If you take the dividend yield on a stock 600 and compare it to the yield on high-yield Europe right now, Eric, is that a cause for concern?
Well, I think if you think broadly about global central banks, and we'll specifically focus on Draghi and the ECB, why are they tightening? Is inflation out of control? No. Is growth great? No, it's okay, but it's not great. It's financial stability. It is their frothiness in asset markets. So when yield spreads, whether it's in U.S. high yield, in this case in European high yield, whatever credit market you're talking about, they're getting compressed, which was an explicit goal of all the easy monetary policy we've had really over the last 10 years since the financial crisis, but sometimes there's too much of a good thing. And so I think that is the number one focus of central banks right now, financial stability, financial market frothiness.
Well, Trey, it's something that doesn't come up much at the ECB news conference, should it? Financial conditions and actually how frothy European credit looks.
Look, I think the ECB's sole mandate is price stability. I think that obviously from a U.S. perspective, the Fed is also thinking about asset bubbles and relative excesses in the system. And one of the things that growth provides and low rates provide is an ability to create those potential excesses. So we certainly have to worry about the low rate environment creating excess demand or false demand and elevation in asset prices. And that's something that I think we need to be thinking about as investors in the marketplace, even though the ECB may not be talking about it.
Gents, you're sticking with us. Robert Tipp from PGIM Fixed Income, Eric Stein from Eaton Vance, and of course Trey Parker from Highland Capital Management. Coming up on the programme, the auction block. The day after the US Labor Day holiday was one of the busiest sessions of the year so far for investment-grade corporate bond offerings. We'll bring you a wrap in just a moment. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. I want to head to the auction block now. And before the debt ceiling deadline was pushed back to December, we had a bit of a nervous market ahead of some bill auctions. Look at this past Tuesday's 4-week Treasury bill auction. Investors demanded the highest rate since September 2008. $20 billion worth of bills sold at 1.3%. We're going to get stuck into that in just a moment. Over in corporates, investors clamoured for bonds now that August is over. Blue chip US and European companies lined up to sell. One of those was Apple. It sold $5 billion in 4 parts, the longest portion of the sale, a 30-year security with a yield of 1.1 percentage points above Treasuries. And despite an earnings warning from Disney and a subscriber loss forecasted by Comcast, investors still buying up media debt in a big way. Discovery Communications sold $6.3 billion to help finance its takeover of Scripps, the longest portion, $1.25 billion of bonds maturing in 2047. Still with us to discuss is Robert Tipp from PGIM Fixed Income, Eric Stein from Eaton Vance, and Trey Parker from Highland Capital Management. Gents, I want to begin with Eric and ask him about that 4-week Treasury bill earlier this week. Why 1.3%? Why higher than the debt ceiling experiences that we've had previously?
Look, I honestly don't have a perfect answer for you, but to me, it's one of the issues with the debt ceiling. So I'm a big fan of anything that breaks debt. I think we need certainly more responsible government in Washington. But to me, the debt ceiling is kind of a crazy way to deal with it. It's all about taxing and spending. Those decisions are what need to be made. Having this kind of fire drill in markets where everyone gets super excited about, okay, this bill is higher than that bill because we might hit the debt ceiling, and no one really thinks the U.S. would default, but people get focused on it. To me, it's more of a distraction than what's important that's going on in financial markets.
Robert Tipp, 1.3% for 1 month money?
It may sound like a lot, and I hate to burst the bubble.
Go on, please.
But, you have to de-annualize it and think about, obviously the U.S. was not going to default. But if you say, what if they did? What did you get paid for that? So it's a 4-week bill. You're looking at like 0.02% in compensation, with 100% of downside. So even if the thing ended up getting delayed, there was some oddity and delayed payment, people say, how much did you get paid for that exactly? Yeah. Even with the 130 yield, it wouldn't look that good.
So this lasted about 5 minutes when they finally agreed to punt the debt ceiling debate until the end of the year. Treasury yields popped a little bit. There was some celebration maybe on the sidelines, the prospect we won't have a debt ceiling anymore in the United States. Then reality started to bite. Treasury yields 2017 lows again, just north of 2%. And if we bring up a chart of real yields are completely rolling over, Rob. You guys, and I've got to say from PGIM, everyone from PGIM that sat around this table out front on Treasuries, bullish like there was no tomorrow. The curve's going to flatten. We've basically got exactly what you guys anticipated. So where next?
Yeah, I hate to say it, but this basically is not over. That all the instances of when yields have rushed up to 2.5% or back in the taper tantrum to 3%, you had an unrealistic expectation about growth. So if you go back to the first half of last year, we were between 130, 190 on Treasuries, and the economy was okay. We're not overheating. Now, before the Trump trade pushed yields up to 265, you had a steepening program put in place, a revamping of policy in Japan. Japan's a very important buyer of Treasuries. That was already pushing up yields here. And you had the ECB going to taper. So you had their taper tantrum, you had a BOJ revamp, and then the Trump trade, which was supposed to, right? People in the extreme, they're very good at panicking in the short term and getting all the bad news into the market.
Yeah.
What was that bad news? It was, well, you could have inflation from import tariffs. You should have tax breaks, structural reforms to bring you growth, infrastructure spending, everything you could imagine, and the thing was up 250, 265. For us, we were like, even if all of that came through, those yields were too high. And you tell me how much of that has come through. And so right now, the hurdles still look very high. They just don't have that much to work with. The fact of the matter is, the underlying economics are the economics. Japan, the yields are incredibly solid, negative, low. Europe, low.
Well, Rob, let's get to the underlying economics, because a Bloomberg subscriber has written in with the following question, and Trey Parker, I want to throw it at you. Your take on Treasury yields around 2%, with GDP growth around 2.5%.
Yeah, it's really tough to reconcile the two, right? You've got inflation to 1.7%, obviously below what the Fed's ultimate target is. You've got GDP growth of 2.5%. Something's wrong, and I think the bond market is mispricing growth. So we have a different view from Robert. We think that there's an under expectation of growth, and a lot of the technical dynamics of the Fed continuing to buy treasuries, and so much foreign flows continue to look for relative spreads or relative yields elsewhere in the world is perverting the market. I think the other thing that's amplifying that is just a general tail concern of some of the geopolitical issues that are out there today, whether it's Harvey, Irma, or Korea. I think those are all things that are weighing on investors' heads. And so you see equity markets at all-time highs or near all-time highs, yet bond yields are at 2%. We definitely think technicals are a key factor behind that.
Well, Trey, let's get stuck into it a little bit more, because the burden of proof so far has been on the high yield crowd throughout 2017. PGIM has been dead right. Going forward, if we had the capitulation yet from all of the Treasury bears that were out there at the beginning of the year, is 2% the bite point, or is there more to come?
Yeah, we think 2% is about as far as it's going to go. We think yields are biased to the upside from here, and that's sort of our view.
Eric?
Yeah, I would agree with that. I'd certainly be more in Trey's camp than Robert's camp. Certainly, global yields being low causes Treasury yields. Whether it was a couple weeks ago, North Korea news, now all the news about hurricanes, that's kept things down. Assuming nothing really, really bad happens, it's just fears, I would think we're getting pretty close to low. I think the other thing that's underpriced, what if we do get something out of Washington? Trump just cut this deal with Democrats to push the debt ceiling off. What if we do get corporate tax reform? Right now, it's not at all priced in the bond market.
Robert, just quickly, tactically, from here, from 2%, as we grind higher potentially, when does PGIM start buying again? 220, 225?
Honestly, the market looks great. We've been on this. This is not a 1 week or a 1 month or 6 month. The structural decline in rates is there. I think all the metrics that people are using to look at this over time, they're not changing fast enough to see what's really going on. And there's not a bubble. The net demand for money is not there between the demographics and whatnot. Long way to go.
Gents, you're sticking with us. Robert Tipp from PGIM Fixed Income, Eric Stein from Eaton Vance, and Trey Parker from Highland Capital Management. Let's get you a market check on where bonds have been this week. 2s, 10s and 30s making new lows for 2017 on the 10-year through the week. At the moment, we are down by 11 basis points on a 10-year through the week, 10 on a 30, 7 on a 2-year. The flattener in vogue again. Still ahead, the final spread. The week ahead features a Bank of England rate decision and another round of data on US inflation and retail sales. We'll discuss in just a moment. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. Coming up over the next week, Goldman Sachs reveals a plan to turn around its performance of its core bond trading unit. Apple launches some new products, the much-awaited launch. Of course, people are waiting for the new iPhone. Jean-Claude Juncker delivers a State of the Union address. I'm not sure how many people are waiting for that. The Bank of England rate decision comes on Thursday, and we get some economic data, retail sales and inflation from the United States on the same day. To discuss, Robert Tipp from PGIM Fixed Income, Eric Stein from Eaton Vance, and Trey Parker from Highland Capital Management. Trey, when are we going to get a clean read on the US economy, considering the events of the last couple of weeks, the natural disasters that are taking place, etc.? Is it going to be a couple of months for this one to come through?
Yeah, I think there's definitely going to be a few months of pause here in economic activity. Obviously, a lot of it depends on the extent of which Irma hits Florida, but certainly Harvey in and of itself, I think, is going to cause some noise in the numbers. We already saw it in the employment data earlier this week, and we think that overall there's going to be a 2 to 3 month lag in economic activity, which should catch up from the economic data.
Rob?
Yeah, I mean, obviously you're going to have a drawdown, and then you're going to have some stimulus. You know, economic losses really don't get factored into the GDP data, but the rebuilding does. So, you know, in the quarters ahead, is that going to be a few tenths of GDP that gets spread out, maybe as much as 0.5%, but it'll be spread out over a decently long period.
Eric, how do you think this demand shock that's going to come about because of this is going to really be absorbed by the U.S. economy?
Well, I mean, the auto sector is a good example. You know, we've seen auto sales come down. Now, given all the, all the cars that were wiped out in Harvey, and who knows what happens with Irma, you know, that means that you may see some uptick in auto production. Certainly not good for kind of a capital stock perspective, but just from a pure GDP accounting perspective, there's actually more demand in this case in the auto sector.
I just wonder, from a trading perspective, Rob, when these numbers start coming through, they're going to have potentially a reflationary element to them. Is that going to be something the market jumps on with established biases, waiting for those numbers to come through?
Yeah, you know, we'll have to see. I mean, trading the numbers is incredibly difficult, and people will be watching for this. So I don't know that there's going to be a strategy of necessarily overreading or underreading. We'll have to see how it comes out.
Gents,
the numbers are.
We're going to wrap things up the usual way we do it, which is wrapping up the last 30 minutes and a look ahead to the week ahead in some ways as well with the rapid fire round. I'm going to ask you a quick series of 3 questions, 1-word answers if possible. You'll have to use a couple of words for some of these. So, the base case for the ECB from here, 40 billion and a 6-month extension, or 20 billion and a 9-month extension. What are we going to get closest to, Rob?
I think the 40 or 30 for 6 months, it'll signal that within 12 months they're going to be out.
Eric?
46 months.
Trey?
Same place, 46 months.
The ECB is discussing the QE options then, and I just wondered if you had to pick one and be long through to the year end, 10-year bunds or 10-year BTPs. Rob?
Oh, no doubt, 10-year BTPs.
Eric?
10-year bunds.
Trey?
I'm with bunds, 10-year bunds.
And to wrap things up ahead of the Apple launch, after Lloyd Blankfein's cautious take on corporate bond yields versus dividend yields, do you want to hold Apple equity or Apple credit? Rob?
I'm equity. Equity looks good. I think strategically the markets are in good shape.
Eric?
Equity.
And finally to you, Trey.
Equity, because I think rates are going up and the duration risk of the IG credit market is pretty
Gents, we've got to leave it there. Great to have you with us on the program. From New York City, you have been watching Bloomberg Real Yield.